Hey traders, Raghee here. Welcome to Charts and Coffee for June 16th. Happy Wednesday, everybody. Hope everyone's doing great. All right, so let's get to it. We've got the Federal Reserve at 2 p.m. and then the press conference at 2:30 today. So this is what the market has been gearing up for, or maybe really not gearing up for. I've got some notes here that is the beginning of the notes that will be used in the live Q&A that we do, live trading, live Q&A that we do every Wednesday over at Sector Secrets. So for those of you that are going to be joining me in the Sector Secrets chat room here in about 19 minutes, this is the beginning of the notes. And I wanted to share this with everybody because this is what we're going to be dealing with today, not just the FOMC, but what are the expectations and what markets could conceivably be affected the most. So first of all, if we step back and sort of ignore, if you will, the triple witching day after tomorrow and today's FOMC statement and presser, the last 2 weeks of June tend to be seasonally a little weak. I mean, they tend to be a little bearish. Not that we're going to see some catastrophic meltdown, but we tend to see some weakness. So I don't follow seasonals blindly. It's if we have not been in rhythm with the seasonal patterns up until this point, I'm not going to suddenly put the blinders on and say, okay, this is the seasonal tendency. And that's probably one of the most irksome things about seasonals, where investors and traders don't consider, are the seasonals working up till now? Therefore, how much credibility should I give them? How much synchronicity do they really have with the market going forward? So, keep that in mind. But that being said, let's keep that tendency. And if we're looking at timing, well, triple witching and the Federal Reserve this week may not be bad timing for maybe a little bit of lethargy at the end of this month. All right. So that brings us to the next point, which is how, if we're talking about this now, this is always what is really interesting about the way that we look at our analysis. I include myself, of course, in this. If we are talking about this now, the group of us, what is the likelihood that it's already been, as the terminology is, what's the likelihood that it's already been discounted? In other words, what is the likelihood that it's already been factored into the market? And so if it's already been factored into the market in large part, then the expectation is that, well, we may not have as big a drop unless the Federal Reserve has something much more hawkish to say. Now, there's a couple ways the market might perceive this hawkishly. Look, this particular Federal Reserve is very wary of getting too hawkish too quick. There's definitely that aspect to what happens. And getting too hawkish too quick does what? Well, it's going to create a drop in the market. And I don't believe that this Federal Reserve wants that. I think they're really fond of putting in V bottoms. They're not fond of putting in V tops. So they're going to be a little bit more wary. But I don't suspect that there's going to be anything more than a shift in the language of the statement. And you can follow that on the Wall Street Journal statement tracker. I don't even believe you need a subscription to the WSJ website to access this. And you can see the way the incremental changes in the statements are made. Expect a change to the inflation statement. All right. Do we expect taper to be in the statement? My gosh, unless the Federal Reserve wants to pull the pin out of the grenade here, no. But inevitably, it's going to be discussed in the press conference. And there's no way it's not going to come up. Expect it to be at least acknowledged, and then expect Jerome Powell just to move on swiftly. So that's what we have coming up. And the real question isn't whether there might be a modification to inflation. That's probably the statement within the comment within the statement. That's probably pretty likely. If one isn't made, look out. That's going to be very bullish. And inevitably, we know taper is going to be brought up. That's pretty much expected. What really the question is when I look at the way in which we have not run up in anticipation of a Jerome Powell event, whether it be a speech, whether it be the statement and the press conference, we haven't seen that run up. So my view of this is unless this statement and press conference, just the wheels fall off the wagon and head off into Hawkishville, I think that the market's already discounting some of what we're talking about right now. Remember, the markets are always forward-looking machines. They're discounting mechanisms. It's what do they think is going to happen. Markets are not Eckhart Tolle. They are not in the now. All right. They are always thinking ahead. And where have we seen some of the biggest drops? In the reflation trade, right? So I do anticipate probably the more vulnerable parts of this market might be momentum, high beta, and the reflation trade's already taken one on the chin. So I think that's where I say some of this has been priced in. We are absolutely going to see a probably nausea-inducing amount of volatility around 2 and then 230. So certainly I'm not saying it's just onward and upward. Expect the volatility, but I am thinking it's going to be largely faded unless the statement is some Shakespearean, tragedy gone wrong, and unless the press conference really, drum goes unhinged. I don't think either of those things are going to happen. That's my opinion of what's coming up. So that's the big narrative today, and expect a lot of quiet until that point, 2 p.m. Eastern, all right? 2 p.m. and then 2:30. So if you're looking at grains and meats, we got long bean oil and hogs yesterday. If you're looking at some of the reflation corners of the market, the sectors, you'll notice, for example, XLB, some of these markets pull back. Others didn't at all. If you're looking for a great place to hide out in this market, I think some places like XLE and XLP have really been quite good. All right. So the other thing is also going to be, I've been talking quite a bit about the currencies, and I still have 6C, 6E, and 6B, or the ETF flavor of FXC, FXB, and FXE. These are all very much in play still. Now remember, the dollar is going to be in play in a big way at 2 and 230. So, those of you that have been watching and paying attention to analysis and watching, I've been a little bit more hesitant with some of these just in this window, this 24 to 48 hour window into the Federal Reserve, just a little bit more cautious. I am pre-positioned in a number of places, but I haven't been that ambitiously adding positions to my book, because if we see some volatility today, well, there's our window of opportunity. All right, so yeah, James, hey there, good morning. I'm still a fan of those currencies, but remember that today's event is going to be really, really impactful to the US dollar, and that might give us a second chance, right? Second chance, maybe more conservative opportunity. In this window, it's really very binary. Either we're pre-positioned and we benefit from the move, or we're pre-positioned and we get Donkey Konged, or we stay flat and we don't add wrinkles to our forehead. It really is a vanity play. Okay. Remember what it is your risk tolerance is going to have to go through today. If your risk tolerance is pretty wide, then pre-position away. If your risk tolerance is not, then we want to stay on the sidelines and take advantage as the dust settles. All right, next up is, so Line Watcher, I think we covered all that. So no, but to tackle the last part of your question, no, I'm not interested in shorting this market. Look, if you go back to, I've been reviewing a lot of Darvis. We have a class coming up. And by the way, if you haven't registered yet, you want to do so really right now, right after Charts and Coffee, because it's happening tonight, 8 p.m. Eastern, 7 Central. We're going to be doing the day trading webinar. And I'm super stoked. I actually have my slides here on the other screen, and we're going over the chart examples and the different tools and tactics that we're going to share. And so one of the things that I've been reviewing for this class, and as we've been over the weeks creating this course, really going back to a lot of Darvis wisdom. And one of the things that Darvis talked a lot about, and by the way, a lot of the automated support and resistance and the signals that you see on my screen, that's not strict or true Darvis, but it's definitely a modernization of the process that he created in the 50s. And the reason I bring that up is one of the main tenets of Darvis is don't short a strong market. So if you are shorting something, it's got to be something that's already in chop and maybe arguably overbought. And then you could take advantage of the move. I'm not a big fan of puts in this market. I don't think that the retracement is, I think a level, a risk, right? Buying puts into the Federal Reserve, that's a risk that I don't really feel like taking. I don't think it has to be taken. I think that I can either sit long already in markets that I'm positioned in or flat and wait for the market to come back down to correction levels that I can get long in. I'm not a big fan of playing the short in an uptrending market. And that is just 60 plus years of wisdom of Darvis. And really, you can also, discuss the same idea for those of you that are Dow theory fans like I am as well. The fact that, neither one of those greats ever said, look, pick a top and short it. Not my thing. I'm sure some folks out there love that timing and that aggressive approach, but not this girl, right? So I'll pass on something like that. So things like Freeport-McMoRan took it on the chin, and so did copper. And I think these corners of the market are actually aggressively buyable because I think the reflation trade will resume. But again, like I said, where is the evidence that perhaps, to your question there, Peter, where is the evidence that the market might be anticipating a notch higher in hawkishness and maybe Jerome Powell having to sort of break it to the market that the punch bowl can't be spiked forever? And I think some of that is being priced in the reflation trade. Comdoll's down, dollar slightly up. Copper absolutely had to take a knee yesterday. Freeport-McMoRan went along. XLB materials pull back. We see some weakness in the grocery store commodities. So I think in those corners of the market, traders there said, look, let's just either get flat, or I think maybe some of those traders got aggressively short in front of Powell. So that's where I think there has been already some adjustment made for this messaging. I don't think this is a market that's completely oblivious to the messaging. And if it's more stern than what's been discounted, yes, we'll see probably some weakness. Again, expect the first wick to be crazy and the market to go in both directions, right at 2. And then at 2:30, again, pop a Dramamine because that's the way that's going to behave, always does. So then the other question is it worse than we thought? And if it's not as bad, well, then the market gets to unwind that trade and then onward and upward. And by the way, in the S&P, in the Dow, in financials, in energies, in basic materials, and a number of other corners of the market, staples, communications, we're still in an uptrend. And I don't anticipate the Federal Reserve putting in a V-top. Yes, some of those trends could be broken. So we could arguably go into the distribution market trend, but I'm not expecting this to be the beginning of some massive move to the downside, especially since the market's already bracing itself for a little bit more hawkishness. We're already seeing that. So unless it's more than that, I'm actually quite optimistically bullish. All right. So which sectors benefit if the Fed mentions anything about tapering? Probably defensives, Vish. Probably defensive sectors. And, if you're in sector secrets, we're already long, some of those defensive corners of the market. So yeah, defensive plays for the most part. Yes, John, I like financials, industrials, the Dow. Absolutely. And back when we transition over to the sector secrets, and again, you're seeing the very, very, very beginning of the notes that I'm putting together for that session here in just a few minutes. Yes, I completely agree. And those are some of the things we're going to be looking at in terms of if we can get opportunistic later on today. In other words, and this is actually a theme that I talk about in my day trading too. Some of my favorite day trading is taking advantage of panic. In other words, when the market opens and we see panic, I'm not going to momentum trade with that flow. I'm usually trying to take advantage of sort of an inflection point that a sort of overabundance of bullishness or bearishness creates. It's like a bungee cord, right? It's like a bungee cord. It tends to snap back. And by the way, just yesterday, If you guys want a great primer to tonight's webinar, check out the Countdown Trader, countdowntrader.com, and got a great video. It's a little bit longer. You're probably going to want to pour a cup of coffee or tea and grab pen and paper, but it's a really good primer for tonight's webinar and for the class that's coming up on the 26th. So, if we're going into webinar mode, we're going to have 2 really great educational webinars. I'm going to introduce the update of the tools, 3 concepts that you must implement into your day trading stats. So we're going to talk about that tonight. And then the class is going to be next Saturday. And I'm super excited. And that class, and a couple of folks asked me, Raghee, if I don't day trade right now, is there anything I can take away from the class? I said, well, I think you're going to realize that having a plan to be nimble, short term, and not care what's going to happen tomorrow, or even in my case, not even caring what's going to happen after noon Eastern, is a really great gear to be able to shift into. But the other thing is, my day trading uses a lot of daily time frame patterns and trends and directional bias. And it's actually going to make you a really good longer term trader. It's going to sharpen your skills there. And that's where, I love where both my styles can come together. And day trading does allow that for me, because I've got to be vigilant about keeping an eye on the daily. And I've got to be great at order execution for all my trading styles. So yeah, I think a lot of people will benefit from, certainly from the webinars, but from the class. And I've got a lot of questions about that. So thanks so much for the interest. I'm super humbled and very excited to present this to y'all. All right, next up is, definitely check out the day trading video over at Countdown Trader, and then I'll see you guys at 8 p.m. tonight. All right, a lot of questions about currencies. Love it. I'm not changing my, if you guys checked out the free video where I discussed pound, loonie, and euro, I'm still focusing on long in those corners of the market, specifically in those currencies. Absolutely. And then as far as some of the financials, as far as individual stocks, Jess, I'm playing an M long XLF. So rather than playing individual boats, I'm going with the tide right now. So I am long XLF. And so unless there's an individual name within the sector that looks far better than the XLF, I'll just go with XLF. One corner, Jess, since you asked, Schwab. Keep an eye on Schwab. I actually like Schwab. It meets 2 of my criteria. One, it's very affordable to trade. As those of you in Sector Secrets will already know this, habitually, I do not like expensive options. I do not like them at all. Most of what we do in Sector Secrets are sub $5 options. So yes, it's small account friendly, but I don't want to get fixated on a small account, because the truth of the matter is, whether it's my day trading or whether it's my options trading in stocks and ETFs and futures for that matter, scalability. So look, whatever your account is now, 5,000, 15,000, 50,000, whatever it is, our goal is to see it grow. So the only way to do that is to have an approach that scales, right? You're not going to suddenly have a brand new style. As I've grown as a trader, my style is actually pretty much the way that it was 2.5 decades ago. I'm coming up on my 35th year of being in the markets. And my style is not that different. What's changed, well, frankly, are the zeros in all the great ways. I'm trading larger now because my account size is larger, my risk tolerance is larger, but it's the same approach, scalability. So what you're doing in your $15,000 account really should be very similar to what you're doing in your $50,000 account or your $250,000 account. And the scalability is the mindset that's going to allow you to do that. So keep that in mind, whether you're short-term or long-term, you really want scalability. Inexpensive options are very scalable. So thanks as always for being here with me for Charts and Coffee. And I will see you all tomorrow, same time, same station. And then remember, I'll see you guys tonight at 8. Even if you can't attend live, be sure to go ahead and register, because this way you'll get the video shortly after we conclude the session. Be good to each other. I will see you tomorrow or tonight.